Obviously, household balance sheets and the state of households is very important. What is the condition of households right now, and how do we evaluate that?
Well, I think you want to look at households both from a cash flow perspective and then from a balance sheet perspective. From a cash flow perspective, nominal wage growth is running at 5, 6, 7% in terms of total nominal wage compensation. Recent figures that were released revised that figure up, highlighting the fact that wage growth is even stronger than many expected. When you have nominal wage growth at 5, 6, 7%, that's pretty strong. That's stronger than basically we've seen in many decades. And that's fueling the ability to continue to spend on a nominal basis at, 5 or 6% a year, which is pretty strong in comparison to what the overall productive capacity of the economy is, which is, closer to maybe 2%, maybe a little bit over 2%, depending on how you think about it. And so from that perspective, households are, from a cash flow perspective, are actually quite strong because they're earning income, they're spending that income, and that's turning around and is becoming other households' income, which is supporting a continuation of spending. It's not a spiral, it's just a dynamic, right? That can continue to happen. And unlike previous expansions, for instance, during the 2006 to 8 credit boom, there isn't a creation of debt that is used to finance that spending. And so there isn't the buildup of liabilities that are unsustainable. And that's where we go to the balance sheet perspective. Household balance sheets in aggregate have never been better. The amount of wealth that households have relative to the liabilities, their net worths, are at all-time highs and have expanded, about 4x over the course of the last couple of decades. That's a great outcome from a nominal perspective. And they've also expanded in real terms. So it's not just on a nominal basis. I think the challenge is that that's super bifurcated in the economy, where there are asset owners, particularly boomers who own houses, or, Gen X or millennials, older millennials who own houses and have taken out, low interest rate liabilities, or have, 60% of people who own their house don't have essentially any meaningful liability. So that segment of the population is doing great. 401ks at all-time highs, houses at all-time highs, low debts. They're doing great. The problem is that particularly younger cohorts who don't own assets and are more on the early stage borrowing side of things are a lot tougher for them. And so that, from that perspective, you have to think about the overall economy is doing pretty well. Overall households are doing pretty well, but there is that sort of K-shaped situation that's going on.
That's actually a good point. So when we're talking about household wealth, are we talking about the average or the median household? And how important is it that a significant percentage of households don't own assets and have actually seen their financial situations worsen as asset prices have risen and as the cost of capital has gone up in recent years?
Right. Well, I think it's important to recognize the median household in the United States is in pretty good shape. The median household owns their home, has a 401k, is invested in the stock market, has a job. The median household probably has, 2 people working a job, and is experiencing a nominal income growth that's around 5 or 6%. So the median household in the United States is doing pretty well. But that doesn't mean there isn't pain for those households that are particularly younger households or younger individuals that don't have houses, 401ks, and are increasingly feeling some pain related to the unemployment, which has been the rise in unemployment, which has been more concentrated in younger cohorts rather than older cohorts so far.